You've probably heard people say things like, I bought the dip, I'm investing in the market, or this company is going to explode. But what are they actually buying? When you purchase a stock, you're not simply buying a number on a screen that moves up and down. You're buying a small ownership stake in an actual business. And once you understand that idea, the stock market becomes much easier to understand. So let's break down what stocks are, why companies issue them, how investors make money, what can go wrong, and the different types of stock you can own. A stock is essentially a unit of ownership in a company. Let's make this more concrete. Imagine a small technology company called Novatech is divided into 1,000 shares. If you purchase 100 shares, you own 10% of the business. That ownership can give you a claim on part of the company's economic value. Of course, major publicly traded companies don't normally have just a few hundred shares, they can have billions. So when you buy a typical stock through an investing app, your ownership percentage is usually extremely small. But the basic principle remains exactly the same. One share represents a piece of ownership. This raises another question. Why would a business willingly give other people a piece of itself? Because growing a company can require enormous amounts of money. A business might want to construct new facilities, hire employees, develop technology, expand internationally, acquire another company, or launch a new product. One way to get that money is through borrowing. But borrowed money has to be repaid, usually with interest. Another option is selling part of the business. When a company issues shares to investors, it can raise capital without taking on that particular debt obligation. Let's imagine a simple example. A bakery called Golden Crust has become extremely popular in one city. Its owner, Sarah, wants to expand into 5 additional cities, but the expansion will cost $500,000. Sarah has $250,000 available. Instead of borrowing the remaining $250,000, she decides to raise money by selling part of the business. She divides the company into 100 shares, she keeps 50 shares for herself, and sells the other 50 to investors. Each share represents 1% ownership. One investor, Daniel, buys 5 shares for $25,000. That means Daniel owns 5% of Golden Crust. Sarah now has the capital needed to expand. Daniel, meanwhile, is betting that the company will become more valuable in the future. 5 years later, Golden Crust has become a national brand. The business that was originally valued at $500,000 is now worth $2 million. Daniel owns 5% of the company, so his stake is now worth approximately $100,000. He originally invested $25,000. If he sells his shares for $100,000, he would have a $75,000 gain before considering taxes, fees, and other factors. That's the basic idea behind capital appreciation. But there's another possible source of income. Some companies distribute part of their profits to shareholders. These payments are called dividends. So an investor could potentially benefit in 2 ways. The stock price may increase, and the company may distribute dividends. But neither outcome should be treated as automatic. Stock prices can fall, and companies can reduce, suspend, or eliminate dividends. Now let's reverse the story. Suppose Golden Crust struggles, competition increases, costs rise, customers disappear. Instead of becoming a $2 million company, the business falls in value to just $300,000. Daniel still owns 5%. But his shares would now be worth around $15,000. He invested $25,000, so he's sitting on a $10,000 loss. This is the part many beginners overlook. Buying a stock means becoming an owner, and ownership means participating in both the upside and the downside.